All right. Hello, everyone. We are now live with you all. And we're just going to wait a couple of minutes to make sure we get everyone before we start, but we will start at 4:02 sharp. So just give us, basically a minute and a half to get started. All right, let's get started. Thank you, everyone, for joining us today for our session on Palico PE Fund Secondaries Masterclass, buying and selling a PE fund stake or portfolio. So before we go any further, let's just start with some quick introductions. It's our pleasure at Palico to be working with Willkie as partners in presenting this today. So I'll let Thibaut and Matthew from the Willkie team to do some quick introductions.
Thanks, Chris. Happy to be with everyone today. My name is Matthew Block. I'm a partner in the New York office of Willkie, Farr & Gallagher. My practice specifically focused on private equity fund formation and secondary transactions. Thibault?
Hi everyone, I'm Thibault Dupont-Rougen from the Paris office of Willkie, Farr & Gallagher. I'm a senior associate and I'm working essentially on primary fund, but also focus on secondary transactions.
Great, thank you guys. And then on my end, I'm Chris Jeffrey. I am the general manager here at Palico and have been here since 2019. I work out of the main office here in Paris, but we do have an office as well in the US based out of Boston. And then just a quick word on Palico. In the simplest terms, Palico is an online marketplace for buying and selling private capital fund stakes. How we do that digitally is the interesting part. We've standardized and streamlined the process for investors looking to buy and sell. So that's very quickly what we do, and kind of building on that. The idea for us here, what we're looking to achieve is really just to educate investors on how this process works, what the best practices are, and essentially leaving with a deeper understanding of how to do this, on a continual basis. All right. And, I'll just kind of also say there is, my colleague Paloma has notified you all, but there is a comment section. As you go through this, please do not hesitate to ask questions in that field. We will have a Q&A section at the end. So we'll come to that at the end. We'll allow the momentum of the presentation to go through as is, but we will have that moment where we will look back and review all the questions and try to answer as many as we can. Okay, so quick agenda. What we'll cover is really kind of from top to bottom, the foundational elements of what is going to go into the buying and selling of a fund stake or portfolio. Everything from kind of the setup to the closing. And then we'll finalize with some trends that we've seen in market. So section one, let's just talk about PE secondary transactions. I think it's worth clarifying that in this discussion, we are going to be talking about LP-led secondaries. All right. So the LP coming to market, looking to sell an underlying fund, in exchange for capital. And so basically there's going to be an exchange of the ownership of that fund, but nothing at the fund level is going to change. So just keep in mind that this is really specifically what we're talking about today. There are different types of secondaries that you are all probably aware of. There's the GP-led tender offer. So essentially, the LPs can choose to sell or stay in the fund. So there's no movement of the existing assets. And really, it's about a buyer coming in, offering a price, and the LP deciding to take or leave it. A different type is a GP-led continuation vehicle. In this case, the LPs that were already in the fund have the option to either cash out or roll over the interest into the new vehicle. So in this case, there is a change of the underlying fund in terms of it going into this new continuation vehicle. This is a much more complex transaction and not something we'll be covering today. And then finally, you have direct secondaries, where essentially it's a buying and selling of the underlying, basically, portfolio companies that can be exchanged. Okay. Real quick, just some trends we wanted to share here. This comes from Caller Capital. Basically, why LPs have been selling throughout the first half of this year. I think the number one thing to call out is the increase in the refocus of resources on the best performing GPs, and then also locking in returns. That's been kind of the really significant change that has been noticed in the market this year. And then, of course, just for your reference, we will be sharing these slides later. Just let us know if you want them. But you have kind of a summary of the different types of liquidity needs that investors are looking for, or how there's that portfolio management. Okay, so now that we've covered that, now we get into kind of the heart of what we want to discuss, what it means to buy and sell a PE fund stake, a portfolio, or a mosaic. And I'll just start there by saying that, you can sell just one fund stake. There are sellers that want to just package together a portfolio of different funds and sell that all together. There are efficiencies to that. But there are others, and this is kind of the new trend. There are what's known as a mosaic, essentially a portfolio of funds, but the buyer can come in and choose the funds within that portfolio they want to bid on. And the benefit here is, yes, it may take more time, but buyers that have an expertise on some of these funds, especially if they're more niche, can provide a better valuation than just a generalist coming in, pricing what they're aware of, and being more conservative on the lines that they're not aware of. Okay, so we've really tried to simplify this so that you all can kind of refer back to this, and this is going to be our guiding principle for today. We're going to go through each of these steps one by one, from the prep to round one, which is kind of that initial due diligence and price discovery, round two, where it's really about deeper due diligence, and the final price, and then finally the closing. So listing setup. So when someone wants to sell, it's key to have some minimal information available for the market to assess. Ideally, you're getting this in front of a number of buyers so that there's a competitive bidding process. What are the details that usually need to be available for there to be at least a reaction to understand if the buyer will be willing to be interested? Of course, there needs to be the name of the fund, an understanding of the strategy, the geography, some description, perhaps the vintage, but also the NAV. Buyers are going to have a different appetite depending on how large the stake or portfolio is that's available. Also helpful to understand what's called, any post-reference date cash flows, and then what the original commitment was. This is kind of the high-level notification on what's for sale, so that a buyer can then say, okay, this seems interesting. I would like to pursue and do further diligence on this opportunity. On Palico, this is of course a made-up fund here, but essentially that information being available within that profile, we call it. If it's a portfolio, then of course we have that lined out below, but just for simple purposes, this is what it looks like. In addition, once you've understood and kind of set up what the important information it is to display, it is then important to have a data room that has the relevant information and the most current information so that the diligence by those interested buyers can happen. We've identified this as capital account statement, the financial statement, and of course, the quarterly report. So you're going to want to set up a data room, and you're going to want to have a check and process with regards to who's accessing that data room, because these are sensitive documents. All right. We've input some kind of optional materials that would be nice to have. If there are any post-reference date cash flows, that definitely should be a part of this. But that may or may not be there. But AGM material PA, that's sort of optional at this point. As I said before, the idea is to then notify the market. This is kind of just from our template of how we have our email go out to our validated KYC investor base. But as was mentioned before, as I mentioned, the NAV, what's called the fund, the strategy, the vintage, and something that's going to be critical is the timeline for that sale. It is very important to have momentum so that these opportunities have the best chance of actually getting the best price, but also momentum to ensure that they close. In many instances, the sellers are going to want to remain anonymous. We obviously work this way while indications come from the market. So this is what we call going live. So once you set up the kind of the overarching information, whether that be for the single fund stake or some sort of portfolio, and then have that data room secured, you're going to want to go live. And then this is kind of just a broader layout of how it would look like on Palico, but this is the key information that we know through our research and work with professional buyers in the space of what they want. I mentioned this before, but something that's going to be very important is you're going to want to have a way to check who's reviewing your documents before you open that access, right? Again, these are very sensitive documents that are really contingent on or are key to a relationship as an LP with the GP. So what we do at Palico, following best practices, is to ensure that there are the appropriate NDAs, and that, of course, all NDAs are signed, have the right terms, before anyone can look at that. And of course, to understand, the identity, ensure that there's no competitors, so on, in this process, before anything is ever shared at all. So it's very important to keep that in mind. So, what I want to, explain here is that this first round, the way that the pricing is going to be made available in this initial round is for the buyers, the relevant buyers, the ones that, are applicable to you, that they have the opportunity to look at the data room so that there's information that allows them to provide indicative bids. That's his whole purpose in this initial round. So that's a diligence that they're going to want to do as a buyer. All right. So once that diligence is done, buyers may ask for more information. Ideally not, because that's where the second round comes in, but that could be the case. But once that review has been done, an indicative bid will be provided. All right. Furthermore, the seller should try to remain anonymous, again, just because of disclosures. But there could be a few questions. The way we handle this is through our integrated chat room. We offer an ability for the seller to remain anonymous as they communicate with the different buyers directly. But the key thing here is that the indications be provided, and usually they're going to be ranges that are provided. And this allows the seller to then make a decision on who to move forward with. Okay, so usually it's going to be price-based, wanting to select from the most competitive indications. And from our experience, that's going to be the most key. Real quick here, I want to talk again about Mosaic. So this is just a quick example. This is a portfolio where the seller's okay if the buyer comes in and selects funds that they're more familiar with and then provide a non-binding or indicative bid. All right. So we just wanted to share with you essentially how that can happen through our platform. Again, that's a decision that should happen before the sale starts, just to understand that as a seller, you're willing to look at different bids. Of course, there are definitely sellers that just are really committed to wanting to sell this all together, it is less work, and therefore it should just be bids on the entire portfolio, and that's perfectly fine. All right. So once those indications come in, it's important to look, be familiar with who is providing those indications, but most importantly, who's providing the most competitive ones. At this point, you're going to hopefully have a nice volume of competitive bids, but you're going to want to do your first selection process. Why is that? That's because these are just indications. We're now kind of going from those that provide indications to then moving on to the further due diligence, which is more involved. All right. So the second round. So now we step into the second round of this process. What we've just done, we've prepared the listing, we've gone live, we've given data room to the relevant players in a secured way, getting NDA signed. But now that we have our selections on ideally 2, maybe 3 buyers, and now it's time, if needed, to have a call with the fund manager. So at this point, and this is something that I'll let the Willkie team talk about. GP consent is something that needs to be top of mind with sellers, but very manageable. And by the way, secondaries, because of their growth, have become quite normalized. It's just a matter of doing things in the right way with regard to your relationship. So here we find ourselves with a selection of, let's say, 2 fund managers. They want to then dig deeper with the GP, have questions for them to really understand what they saw in the data room. So these are going to be 1-hour calls for that to happen. Once that call has been done, then it comes to the binding bids. The buyer will step away, take a minute to review what they saw, and then the professional buyer, and this is how we work on Palico, they should provide not only a final bid, but it should come with an LOI, not only stating whatever discount, percentage of NAV they're going to give, but also the dollar or euro or whatever the relevant currency amount is, so that there's no doubt with regards to what their offer is. Really quickly, we kind of leave this with you all to keep in mind. There are many variables that go into how pricing will be determined by the buyer. So real quick on the left, we just kind of gave a number of the most relevant ones. Remember that, and this is what's interesting about pricing, and we're going to talk about them in terms of the trends. If a secondary fund comes, and this is what they're investing in, if their return expectations are higher, they're going to be more aggressive with the discounts, right? So that's kind of really based on what their returns are to their own LPs. So keep that in mind. But of course, other things are just going to be, and that's point number 3 here, but the geography, the strategy, all these things are going to be played into this. And then another thing, I had mentioned the post-reference date cash flows. So in this case, there was a discounted NAV that's been priced in. But if there was, and so that NAV is going to be based on the reference date, so that quarterly report, but they'll also then either remove or add to that final purchase price, depending on whether there were distributions, net distributions, or capital calls to then reflect essentially that cash balance. And then one more thing, when it comes to portfolios, this is what a buyer is normally going to do. They'll look at it line by line and then determine kind of the price that they're willing to pay on those lines. Again, this is where it comes back to a generalist looking at an entire portfolio. They may be more conservative on certain lines, which then comes down to a final price, whereas a Mosaic would allow experts within that industry to then really focus on that and maximize the price because they're aware of the risks and opportunities within that fund. Okay, so then we get to the fun part, which is the final selection. The buyer has provided that LOI, or multiple buyers at this point, 2, maybe 3. And of course, here it's about selecting if that price is still good, selecting it, and then moving on to legalese. So for us at Palico, this is where it kind of goes offline. as we like to say. But you've gone through the entire selection process. You've gone through price discovery. And of course, at this point, if it hasn't been done already, the seller will have to reveal their details, because now we're going to get into kind of the conclusion with all the legal documents, SPA, transfer agreement that you see down here, that I will allow the Willkie team to explain in further detail. So with that said, section 3, legal and closing, I will hand it off to Matthew.
Thanks, Chris. And, again, we're delighted to be with the Palico team today, and we thank you for letting us be part of this presentation. So we're going to go through a few topics. We'll start with key information as a buyer, because, as Chris mentioned, there's a lot of information that's presented to buyers from the seller, from the sponsor. And, I'll turn over to my colleague, Thibault, to talk about some of the, things as a buyer you'd want to ask the seller or the sponsor.
Thank you, Matthew. Thank you, Chris. Obviously, the first question we ask ourselves is, why does one seller want to sell his shares in the fund? He might have several reasons to do so. They might want to have some liquidity. They might want to decrease their exposure to certain risk and to increase in other different kind of assets. They might also have a mismatch between the investment horizon of the GP and their own horizon. So they might have several reasons, but in any case, they are going to try to sell their shares in the fund. For most sponsors, they always organize the transfers within their funds by quarter. The reason behind this, again, they might have several different reasons, but the main reason is to avoid having financial reporting inefficiencies. They also want maybe to just gather all the transfer together within 1 quarter, so they can easier to deal with all these transfers. So the main thing to know for the buyers and the seller is that they might have to deal with a deadline set by the GP, and they will have to work with this. In any case, what they want to do at this stage of the transaction, that they want to better understand the structure of the fund, especially obviously for the buyer who wants to dig deeper into what is going to invest in. So does the structure of the fund works from the legal, tax, or regulatory perspective, for example? They will also try to get as much information as they could on the capital accounts, the capital calls, the distribution that have been made or are going to be made within that time frame, as I was speaking earlier, because that might have a huge impact on the pricing of the shares that are going to be sold by the seller. In any case, and as Chris rightly mentioned that earlier, they want to dig deeper into the underlying assets within the portfolio they're going to buy, because first of all, they want to see if every asset that they're going to be indirectly invested in matches their own criteria, their own investment policy, for example. Maybe they will have to ask for a specific excuse right on one or several different kind of assets, because that doesn't match for several reasons. It doesn't match their investment policy. So at this stage, there's a lot of back and forth between the GPs, their lawyers as well, and the buyers, so they can have a better understanding of the assets. And at this stage of the transaction, that's where we usually see the buyer requesting to either benefit from a potential side letter that has been agreed with the seller, or maybe they will negotiate their own side letters because they might have their own condition, their own right that they need to have within this transaction, because they're going to be LP in the fund. So as every other LP, they might have some right that they want to benefit from. This also have at this stage some issues when it comes to set the perfect amount of undrawn commitment that will be purchased by the buyer. And they will at this stage also have to deal with the potential confidentiality risk that might occur here in these circumstances. For example, if the GP is willing, obviously, to let an investor sell its shares, but the potential purchaser is or may be a competitor to the GP, they will have to, or the GP might have to ask the seller and the buyer to restrict the information that is being shared, because there might be some conflict, obviously, and they don't want to share sensitive information to the potential buyers or potential competitor. So that pretty much sums it, this part of the presentation. I'll let Matthew take away from that.
Thanks, Thibault. That was great. This is the structure that Chris highlighted earlier. Generally, the structure of an LP-led secondary. The key thing here is it's an over-the-top sale, right? So the seller is selling its limited partner interest in the fund directly to the buyer. There's no change at the fund level. There's no change at the portco level. From the sponsor or GP's perspective, they have a very limited role in LP-led secondaries. The fund documents will generally have a prohibition on transfers, other than with GP consent, right? And there's good reason for that. The GP is a fiduciary to the fund. Its main obligation is to act in the fund's best interest and to protect the fund, and to obviously make investments and generate returns. And so, if they do something, and transfers can, present a risk to the fund, right? Funds generally are illiquid, and you can't, at least in the U.S., if you buy and sell interests in a partnership freely, the IRS takes a view that it looks like a corporation, right, with shares being exchanged and whatnot. And that's really not the intent of a partnership. And so if you have a lot of transfers as a sponsor, the IRS could view the fund as a corporation, and that from a tax perspective could be bad for LPs, right? The GP also needs to make sure that all the investors in the fund, are suitable from a securities law perspective, and that they have a minimum amount of net worth and comply with the private placement offering regime in the jurisdiction. And so, all those taken into account, the GP is going to make sure it's comfortable that the transfer and the buyer are otherwise suitable to make the investment in the fund before it gives its consent. Moving on to the key documents for these transactions, it's really the purchase agreement, the transfer agreement, and any side letter that the buyer needs in order to make the investment. So starting with the purchase agreement, Chris talked about purchase price adjustments. Generally, purchase price is going to be some discount to NAV, right? And it's going to be struck as a particular reference date. And so if there's changes between the reference date and the closing date in the form of contributions that the sellers made or distributions the sellers received, there's going to be an adjustment there. If it's a mosaic, or if there's a portfolio of interest being sold and one, for whatever reason, drops out, whether the GP won't consent to it or some other reason, there will naturally be adjustment to the price to reflect the fact that the one or more interests and funds are not being taken into account as part of the transaction. Reps and warranties in these deals are pretty general, right? They're knowledge qualified in many respects. They really touch on some of basic items on the transaction. Dual authorization, title, no conflicts, very general. Like the seller has the power to enter into the agreements. The seller has good title to the interest. The seller hasn't pledged the fund interest or hasn't put any liens on it. And the seller generally has, is not conflicted in the sense that, signing the purchase agreement or transfer agreement isn't going to breach the seller's obligation under any other document or under law. Material agreements, the seller has to disclose any material agreements it's party to. Usually that's the fund partnership agreement and the amendments, any side letters, things like that. There'll also be reps to make sure the seller hasn't breached those agreements. So, for example, the seller isn't under default in the fund documents. The seller has made all the contributions that the fund manager has called for. Because obviously, as a buyer, you don't want to step into a breach. No litigation. The seller isn't party to any litigation. The seller hasn't used any brokers or isn't paying a placement agent fee. That for I think a lot of buyers, certain buyers, can be sensitive topic if you have pay to play issues and things like that. Source of funds. As a buyer, you want to make sure the seller hasn't hasn't used money from illicit sources to make capital contributions from the fund, because the sponsor will have certain recourse in those events. And then no reliance on the buyer. This is usually just a rep that the seller gives that says the buyer hasn't provided any information, or the seller isn't entering into these contracts on using any information that the buyer has provided. The seller is a quote unquote big boy, or a sophisticated party, and is entering into these agreements its own volition. These are sort of seller reps. The buyer reps are generally the same, but I would add that the buyer gives the seller a rep that it's got the cash to close, right? That's a pretty typical one, and pretty non-controversial. Covenants, there's a covenant that the seller provides notice of certain events that occur between signing the purchase agreement and closing, if there's an executory period, right? So if you sign the purchase agreement 2 weeks or something before closing, and there's litigation that comes up, or the seller has made contributions to the fund, or the sponsor has amended the fund documents, those sort of notices have to be provided to the buyer, and the buyer should get a chance to review any amendments or take those into account prior to closing. Just continuing, there's conditions to closing. These are, standard. The reps and warranties remain true. Again, this is in the event there's an executory period between signing the purchase agreement and closing. The parties have performed the obligations under the purchase agreement. The GP has consented, right? You can't really consummate these transactions again without GP consent. So that is actually a big condition to closing, is ensuring that the sponsor is indeed giving the consent to the transaction. Survival and indemnities, this is a negotiated point. We generally see, we sometimes see reps and warranties die at closing. Other times we see them survive for up to 12 months following closing, other than for fraud or nefarious things, right? So, if the seller has, intentionally provided false information to the buyer, a fraud claim will survive through the statute of limitations provided in the jurisdiction for fraud, right? There's reciprocal indemnities, right? So, if the buyer has breached a rep in the purchase agreement, it will indemnify the seller, and vice versa. One key thing to think about here is, and then we'll touch on a little bit on the next slide, but sponsors view themselves as having a limited role in these transactions, right? They're just providing the consent necessary for the transaction to go forward. So if the sponsor or the fund in particular is damaged as a result of this transfer, right? Say, for example, the buyer gives a bad securities law representation, and for whatever reason, it ruins the fund's private placement exemption under the particular regime, and the fund is damaged, the sponsor on behalf of the fund can seek indemnity from either the buyer or the seller, right? The fund, it's usually joint and several liability from the perspective of the manager, again, because they're a fiduciary, right? They have to protect the fund, and they have a limited role in these transactions, and the manager is going to want to go after either party, and then it's up to the buyer and seller to allocate that risk, right? So if the fund is damaged as a result of a buyer breach, and the fund goes after the seller is permitted to seek contribution from the buyer for those damages. And then lastly, limitations on indemnity. You usually see indemnity limited to the purchase price. And sometimes you see things like tipping baskets. So you'll see maybe a 1% tipping basket, meaning, if there's if the buyer breaches a rep and the seller's damaged, but it's a nominal it's a nominal amount of damages. It doesn't exceed 1% of the purchase price. The seller sort of has to live with that risk, right? And the reason is that, seeking indemnity and possible arguments back and forth between the parties could exceed that amount. So this is now, we're moving on to the transfer agreement. This is really the document where you're getting GP consent, right? This is so the purchase agreement is between the buyer and seller. The transfer agreement is between the buyer, seller, and the sponsor, right? And so the sponsor is agreeing to provide consent, and the sponsor is getting, the AML, tax suitability, securities law representations that they would normally get in a subscription agreement, right? This is from the sponsor's perspective, the buyer is really providing these as a new subscription. Expenses, the general rule is buyer and seller bear their own expenses. Any expenses incurred by the sponsor or the fund for giving consent and doing, dealing with the transfer agreement are split 50-50 between buyer and seller. Indemnity, we talked about, usually joint and several for managers. For the manager, they can go after the buyer or seller. GP consent, and then there's usually a waiver or release of claims for the sponsor. We did want to touch on some current trends in secondaries generally. In the U.S., the SEC just passed an overhaul rule, probably the largest since Dodd-Frank here, really focusing on conflicts and transparency as it relates to both registered and unregistered investment advisors. There aren't many. This rule in particular about advisor-led secondaries, not necessarily relevant to this discussion because this is really for GP-leds, but one area that they've really focused on is, again, conflicts and GP-leds are conflicted transactions. So there's the requirement to provide fairness opinions to buyers in these transactions. So if you do happen to find yourself as an LP buyer in a GP-led secondary, you are entitled to receive a fairness opinion and any conflicts that the fairness opinion provider has dealing with the sponsor. So that, not necessarily a change in market, all that much a change in market practice, because this has really been going, sponsors have been getting fairness opinions for years now for these transactions, but now codified by the SEC. Two areas that I do think could impact LP-led secondaries, non-pro rata expense allocation. So if you as an LP or if the fund is getting a non-pro rata charge of expenses, meaning as an LP, you're bearing an expense that not other LPs are bearing, right? It's getting specially allocated just to you. Or if an expense is getting allocated specifically just to one fund versus a number of funds that a sponsor might be managing, there needs to be disclosure on that, specific in the form of a statement, and it needs to be provided to LPs prior to that allocation being made. Again, this rule really focusing on conflicts, really focusing on transparency, and ensuring that the sponsor is providing LPs with information both pre-commitment and pre-allocation, and so this is one. If you're an LP and you're getting a non-pro rata allocation, you should you could be expecting some sort of disclosure on this. And then the last point is preferential treatment. This really relates to side letters, and so the rule basically provides that if a sponsor is giving an LP preferential terms on economics, on fees, on liquidity, on reporting, all that needs to be disclosed up front to an LP pre-commitment. And then for other sort of non-material preferential treatment or preferential side letter provisions, those should get provided in the illiquid fund context as soon as practicable after the final close. So in the case of an LP-led secondary, if you're a buyer and the sponsor has given an LP preferential treatment on fees, on liquidity, on reporting, you would be getting disclosure of those things before closing, before you're admitted as an LP in the fund. These rules go into effect on a rolling basis. So for managers with AUM greater than 1.5 billion, they come into play in 2024. For managers with AUM below 1.5 billion, they go into effect in 2025. And then, Chris, I think I'll turn it over to you to talk about secondary market trends.
Yeah, great. Thank you, Matthew. So a few things. So we, we've kind of gone through the full process from top to bottom. A great summary from Willkie, really with some very timely rules that are coming out, especially for the US. But now let's talk about overall trends that we're seeing. So no surprise, I think, to anyone that's listening to this, PE secondaries have been growing substantially. There was a decline in 2022. A lot of that having to do with the market volatility at the time. The more there's a spread between the bid and the ask, the less likely there are for secondaries to clear. In 2023, that's changed a bit. Now that the dust has settled a bit in markets, probably depends on who you're talking to, but that's been more robust. But the key takeaway here is, compounded annual growth from 2013 to 2022, 17%. So it's here, and it's only going to become more and more the norm. Pricing. So this is for pretty much the first half of the year. This was released by JP Morgan, and these prices definitely align with what we've seen at Palico. So yeah, there's been a dip in 2022. Those numbers have rebounded a bit in 2023. For sure. There's no doubt buyout has been the most resilient, with pricing, depending on the fund, going up into the 90s. A lot of that having to do with a flight to quality. Real estate getting hit pretty hard, especially commercial real estate and venture as well. I think we've all seen, especially cash flow negative portfolios, even in the public markets, have been hit hard there. And so that's reflective of what we've seen in venture secondaries, with pricing, for us at least, coming roughly at 50 to 60% of NAV. But that, of course, is always going to depend on the fund. There's especially in venture, a bottom-up analysis on that portfolio. I will say that just recently, and I apologize that we weren't able to incorporate this into the presentation, but Park Hill just this week came out with their own market pricing. And as I said before, there's been a bit of a rebound with pricing from buyout, credits, even real estate popping up a bit more, but still real estate, they have it quoted at 70 to 70. But venture still a bit lower. So if you guys reach out to us, we're happy to also make sure we get you a link to where you can download that as well, because very useful information. We ourselves at Palico will be creating our own pricing report in the near future. So it's not available yet, but definitely pricing that we're seeing from both, when this came out with JP Morgan, but also Park Hill, in line with what we're seeing. And then I'm going to hand it over actually quickly to Matthew on the implications of AI in the private markets.
Yeah, sure. Thanks, Chris. We've all sort of heard about AI and concerns that folks in industry and government officials and politicians have over AI and how it's going to impact the economy. And we've all, I think, on the legal side, have seen there was this airplane case, or someone sued an airline here in the United States, and the lawyer used an AI program to create a brief that included cases that didn't exist, and sort of got a tongue lashing from the judge. And so, I think there's some work to be done on AI generally. But I wanted to just flag, we've seen firms, and we've heard presentations from firms in the marketplace now that are trying to build technology to sort of streamline the legal documentation process. And not that, these transfer agreements and purchase agreements are all that, you need from transaction to transaction. There's certainly negotiation that goes along with it. And, there's firms out there that are trying to sort of streamline that process through AI, whether that be, using AI to create forms that can easily be generated at the beginning of the transaction, or can take input from the parties and then translate it into a workable contract, without having to spend the time to actually go through it and create it. And so something on our radar, something that I think is on the radar of a lot of participants in this market, and we would be remiss not to mention it here.
Yeah, thanks, Matthew. This one, certainly, I mean, I know there's always these hype cycles, but on this one, this whole movement around AI, it seems to be the real deal. So thanks for kind of that heads up on what's happening there. Look, we want to get to the Q&A. We want to answer your questions. Just to finalize, these are type of funds that have gone listed and live on Palico for sale. One quick thing is we are specialists in smaller fund stakes. So what we define as starting out at $1 million US or euro, and that can scale up to 30, 40, 50 million. But really kind of especially an outlet for smaller institutions that have smaller tickets that don't necessarily get the visibility that your kind of status quo broker will take on because of the minimums they want to keep and the amount of work that it requires them. So that's the quick thing on Palico. But most importantly, we would love to turn this over to you all. Q&A. This is a great opportunity. It's free. So you might as well take advantage of that. So we already have a question from Marie. And this is for the Willkie team, I think here. What are the amount of expenses that you typically see in a transaction? So is there a way to identify the fixed costs, I guess, and maybe what are the variable costs in going through this transaction?
Yeah, it's a great question. The obviously the buyer and seller are going to bear their own expenses, and part of the variable there is what is the portfolio. If it's a single LP interest in a single fund, and there's sort of minimal diligence around that, right? It's you're going to be focused on what are the rights the seller currently has, either through side letter, what has the seller contributed, what are distributions, what are contributions, what are the capital accounts, a review of the fund agreement, and any amendments in the offering document. To the extent you have a bigger portfolio than that and you're having multiple funds, that's going to sort of add to the cost, because you're going to essentially be reviewing and diligencing. I would say, it's probably from a legal fees, would be 25,000 US, I would think, for a single fund, and that goes up incrementally for each fund that's added, and that's assuming that negotiations on the purchase agreement aren't drawn out. Usually they're not, and I think usually parties are pretty reasonable when it comes to negotiating the documents. And I don't think the transaction documents would differ all that much in a multi-fund portfolio. So it's really, the diligence cost for reviewing the document or reviewing the fund documents is the big variable there. From the sponsor perspective, again, the buyer and seller are usually going to split 50-50 the cost of the transfer agreement. And, again, I think the number of funds in the portfolio is going to be a factor there, because you're going to have to do an investor suitability questionnaire, which is basically the sub book or the intake form for each one. That it's probably not going to be all that much money or much time to do. And sometimes I think sponsors have electronically done this or have used services that streamline it to make the process digital, so it's not someone actually filling out that information. But what we generally see is the cost associated with that to be somewhere between 10 and 20,000 US dollars. So again, split between the buyer and seller, you could expect, somewhere between $5,000 and $10,000 each party bearing for that. So, I think to answer the question, the variable is how many funds are part of the portfolio, and I would in a deal where it's one fund, I would probably expect to be in the neighborhood of somewhere between 25 and 30,000 for the transfer.
Right. Thanks, Matthew. And I can take the next question here. What are typically the buyers we see? So it's a great question. We're very lucky at Palico. We've worked hard to have a very robust investor base in general. So, the quick answer here is it's the secondary funds. So funds that have been raised specifically with the mission to source and seek out deals on the secondary market. And so they've raised, capital to do this very thing. So they're going to have the biggest appetite. And also there's an expertise they have in doing this that gives them an advantage. So our data shows that on average, they're about half to 3/4 of the actual interested buyers in a sales opportunity. But that being said, there are half to 25% of those that are made up by family offices, pension funds, endowments, foundations, all split pretty evenly. Although I will say that our most active users overall are family offices. So there's a bit of an inclination, but that's more kind of, I think, a testament to where we're positioned as Palico. And so in terms of family offices, our understanding, our expertise, and just our awareness of the community, that's specific to us. And then here we have another question. Is there a view on the kind of companies being considered for LP-led secondary stage sector valuation? I guess it's really depending on the profile of the buyer. So is this buyer bullish on what they think they can get in VC? So I'll just use that as a quick example. We've seen some pretty heavy discounts in the VC sector, but that could also be a great opportunity to buy stuff that's cheaper, and that if you have the expertise, and this is especially important for VC because you really need to understand that sector to understand, there's no underlying, in the most cases, there's no real cash flows to do kind of traditional analysis on these. You really need to understand whether the growth path and the market is there and available for those companies to be successful within that fund. If I had to kind of globally answer this, frankly, there is a flight to quality. And so the most popular sector where we definitely get kind of the most appetite from our buyers is when anything in the buyout space goes for sale. There's definitely a lot more comfort in buyout versus, VC, especially if it's, early stage versus, a late stage growth. Anything from you guys at Willkie on that specific question?
No, I think that's right.
Maybe
I think it's going to be, yeah. Sorry, go ahead.
Sorry, go ahead.
No, I was going to say, to echo you, some of it's also going to be dependent on mandate and what a buyer is looking for in terms of exposure, types of strategies and whatnot.
Yeah, and I think a big one that we hear a lot is diversity. So actually, when it comes to like portfolios or just even funds, the diversification of that fund will give comfort to that buyer as well. So it's actually being too specific can also be a problem. And then you added there valuation. Yeah, that, we do have buyers that are more comfortable with, if we're talking about valuation, just kind of overall NAV, larger stakes that are for sale versus smaller. But one question I wanted to ask the Willkie team myself that we get a lot is, just managing GP consent, when to do it. Do you guys have like specific rules? I know. Go ahead.
Yeah, I don't think there's any bad time to do it. I think it should be, well, sometimes you even see sellers going to the GP before, like, for example, a seller may go to the GP and say, we need liquidity, we need to get out of the fund, can you help us market our interest? And so the GP is brought into the fold immediately, or even at the beginning. I don't see any reason to delay it. I think bringing the GP into the fold early on is in the best interest of both parties, because you don't necessarily want to get down the path of having a negotiated deal only to bring the GP in and say there's an issue. We've hit our limit on transfers this year, and we have to push it to next year. Otherwise, we have a publicly traded partnership issue, which is the one I noted earlier. There could be a variety of reasons that the GP may want to push the transfer to next year, or may not be able to do it at all.
I think when we say that the GP consent, I think there are two kind of GP consent. There, the legal and the commercial GP consent. For example, when we represent the GP, we usually get like an introductory email from the GP to the buyer saying, well, we agree to the idea of you selling the shares. Obviously, it's pending on getting the legal done and getting over the line. And then at the end of the transfer, at the gate date, we have the GP formalizing this consent through a paper that is executed by the GP. But we got the commercial GP consent before we get the legal consent.
Yeah, and just kind of to echo that, we, on our end, we always think it's better to start talking to the GP ahead of time. That way, it's just great to even have the GP clued into who they may want this visible to or not. But we also understand that there's a process that a seller may want, which is to just understand, hey, what's the pricing before I start kind of getting into that with a relationship that I have that's ongoing. Both are the right answer, and both happen in the market. It really just depends on that relationship. So we're at the hour mark. Thank you all for being here. A special thank you, Thibaut, Matthew, for being here with us. Please get in touch if you have questions. Oh, and we just got one final question, Giovanni. Let's see if we can do it quickly. Have you ever seen initial commercial GP consent and then after weeks of work a deny? No. I have not seen that on my end. I don't know if Willkie has some examples. No. Yeah.
Yeah, I think that would be an IR issue. I think a sponsor would turn something like that. Agreed. So quick answer there. But anyways, wrapping this up, thank you all for your participation. Really appreciate it. Please reach out to us if you have any questions, and let us know if you want any of these slides. And I mentioned the Park Hill documents, and then you have Thibaut here, Matthew,
please get in touch with them with anything in the future. This is our team here. Paloma, you saw her chatting, and Antoine's our founder as well. Over 20 years in the PE space, almost 30 years. So yeah, thank you everyone, and we look forward to staying in touch.
Thanks, Chris. Thanks, Palico team.
Bye.
Thank you.